Inventory costing methods, a screencast by Christina on Focus. Now, the cost of inventory units for a business change. We all understand this, we've all been there. We buy a sweater for $30 and end up at the same shop the next day, finding it to be $20. The inventory costing methods are alternative ways to assign the total dollar amount of goods available for sale between ending inventory and cost of goods sold. There are 4 different types of inventory methods used. They are the specific identification method, the average cost method, the first in first out method, and the last in first out method. Specific identification method. This is used by businesses whose inventory items are expensive or have one-of-a-kind characteristics, such as cars, high-priced jewelry, and works of art. This method requires keeping track of the purchase cost item by either coding the purchases or keeping a separate record of the unit by means of serial or identification number. However, this method is impractical in dealing with large numbers of similar items and tends to get a bit confusing. The average cost method is based on the average cost of all inventory items available for sale during the period. It requires the following calculation. The average cost equals cost of goods available for sale over the number of units available for sale. So let's say we have 6 pairs of shoes, all costing different amounts. 1 being $50, 2 being $100, and 3 being $200. To find the average unit cost, we times the number of units by the unit cost, giving us a total cost. Summing this up, we have a total cost of $8.50. The average cost becomes $8.50 divided by 6, 6 being the total number of units, giving us our average cost. The next inventory costing method is the first in, first out method, otherwise known as FIFO. This method assumes that the earliest good purchased are the first sold. These are our goods available for sale, the 100 at the bottom being the oldest bought and the 170 being the most recent bought. Now, selling the merchandise in this method, we say that the last bought becomes our ending inventory and the first bought becomes our cost of goods. First in, first out, cost of goods sold. And our last method is the last in, first out method. Now we have the same numbers as the previous method. These become our goods available for sale, except what's different here is our most recent become our cost of goods, and what we're left with is an ending inventory. What we see using this method is that 420 is lower than the 540. So those are the 4 different types of inventory costing methods. However, it's very important to remember that although there are 4, the last in, first out method is not proved by the GAAP and is not allowed to be used in Australia. Thank you for watching.